Are you looking for a great deal in today's market? Well, it may not just be the house price. It might be the mortgage. What if we could help you get a 4% or less mortgage as a buyer? Follow us, check this out. We're going to talk to you guys about an assumable mortgage and how it can help you. Hey, I'm Gary Meek. I'm with the Living in Sacramento team, and you are following us today. You are checking out this video because you want to know what an assumable mortgage is, and we're going to jump into it right now. So you're interested to find out what an assumable mortgage is? Well, there are only two mortgages that are actually assumable that you can do legally and still take ownership and title to the property. First and foremost, you got the FHA loan, where a person is going to assume the seller's current FHA loan. Now, of course, rates are in the 6-7-ish% range, and we are looking for rates that are in the 4s and in the 3s. That's going to help save you hundreds of dollars. Now, the second one is a VA loan. Now, you may think, oh, I'm not a veteran, I can't assume a VA loan. Well, that's actually not 100% the truth. You as a buyer can actually assume a VA loan, which is pretty amazing because with an FHA loan, you got to pay mortgage insurance. But with a VA loan, there is no mortgage insurance. So it actually saves you an additional $100 to $200, maybe even $300 on the mortgage. So one of your questions might be, well, how do I apply? How do I qualify? And that is really the interesting part. If you are already set up and qualified for an FHA mortgage at that 6.5-7% range, whatever today's market value is or market rate is, you actually have to qualify based on today's rates, right? So if you're qualified, you've got a set payment, a set dollar figure, we may be able to actually help you get into a house that's $50,000 to $100,000 more loan than what you're currently approved for because the payment's going to be the same. Yes, it is true that a payment on a 4% interest rate versus a 6.5 to 7% interest rate could be savings of $500 or more every single month, or it could be $50,000 to $100,000 more in purchasing power. So we're going to jump in and we're going to talk specifically about mortgages, and I'm going to share my screen and show you what's going on and how the difference is between today's rates and an assumable mortgage. We're going to show you guys exactly how much more buying power you have. We're going to show you how much money a month you can save. And then we're going to show you actually over the life of the loan, how much money you're going to save. So check this out. All right, so here's our first scenario. If you are qualified for a $500,000 house and you're putting about $20,000 down, right? It's going to be your 3.5% on an FHA plus some closing costs. It's probably going to be about $20,000 out of pocket. So if you've got that money set aside, got it from grandma, borrow from your 401k, that's about what you're going to need. And if you look at the screen right here, a $500,000 home with a $20,000 down payment gets you a $480,000 loan at 7% interest for 30 years at taxes of $5,000 a year, PMI, that's the mortgage insurance against the property because it's an FHA, or against the loan because it's FHA. Then we've got homeowners insurance at about $1,199, $1,200, about $100 a month. You'll see it's FHA, and I hit calculate. You'll see that the payment here is $39.10. So if you are qualified today with your mortgage person, you're trying to buy a $500,000 house, your payment's going to be right about $3,900 if you're getting FHA. Now, in this scenario, you'll see also that I have $500,000, I have $20,000 down, I have a $480,000 loan amount, but I have a 4% interest rate. Same thing, 30-year note, $5,000 for taxes, PMI is at 0.5, homeowner insurance $1,199. Look at the difference in this payment. It is barely $3,000. That is a $900 a month savings for you as a buyer. So if we could find you a property in today's market that has this assumable type loan at this 4% interest rate. Now, interest rates aren't going to be exactly 4%. We're going to find some that are a little over 4, a little under 4, but we're running this as just a scenario. To think about this, if you're at 7% today and you're qualified and you saw that that payment is $3,910, but if I told you I could get you the same house at a 4% interest rate, I am literally going to save you $900 a month. Does that sound interesting? Is that something that you would be interested to find out more about? Well, not every real estate agent fully understands this process. And this is something that I specialize in. I am a number cruncher. I understand the process. Been doing real estate for 20 years. And now is the time that we can take advantage of these while their interest rates continue to go up. So here's what I want you to also see. The interest paid right here is $344,973, pretty much $345,000. That's what your interest you would pay over the life of that loan if you got it at 4%. But if you were in today's economy and you were getting that 7% rate, like I showed you over here, look at the total interest paid. It is $669,000, pretty much $670,000. That is literally double what your interest would be if you get that 4% rate. So if you want to find out more information on how to get in touch with these kind of properties, we are the ones that can help you out. I'm Gary Meek, I'm with the Living in Sacramento team, and we are the ones that are out there looking for these loans, trying to find these properties for our people. And we're ultimately marrying someone that has to sell their property for whatever their reason is. And they've got this great, amazing interest rate. And we want to be able to sell you that amazing property and save you $900 a month. Now, I'm going to also show you another scenario. So check this out. We've talked about what it was to get you at a $500,000 purchase, $20,000 down at 7%. You knew that that payment was about $3,900. But look at this scenario I have posted here. This is a $650,000 home at 4%, and your payment is $3,870. Now, I want you to think that through. We were talking about a $3,900 payment, which you qualified for, and you thought, man, $3,900, I can make that work. And I'm only getting this $500,000 house. And I'm now telling you, I can get you a $650,000 house. That is $150,000 more house. It's probably bigger square footage. It's probably got an extra bedroom. It might be in a nicer neighborhood. It might be in a better school district. It might have a 3-car garage. It might even have a pool. But look at the difference. You go from a $500,000 house at a $3,900 payment to a $650,000 house with a $3,900 payment. That is truly life-changing. You'll see also the interest paid is still only $452,000, or $453,000 if you round it up. So you're paying less in interest over the life of the loan. You're getting a tremendously larger, better, nicer house, maybe fully remodeled with every single thing you could possibly imagine. But not every agent knows this. Not every agent understands how this works. And we are going to show you exactly how it works. We're going to find you the house that fits your criteria, fits your monthly budget. We're going to be able to get you that house more than you ever thought possible. So let's get into a few more of the details. Now, the great thing about this is you still have roughly about the same amount of closing costs, but this process is going to take longer. This is not, I'm going to write an offer and be in it in 30 days. When you are doing an assumable mortgage, it is going to take longer. It's probably going to take 60 days. So we tell everybody we want to set the right expectation and plan that you're going to be 60 days. But for 60 days, an extra 30 days, extra 45 days, whatever that takes, you are either going to get so much more home, or you're going to get the same house you had planned for with this massive amount of savings. You don't have to hope. You don't have to wait for the interest rates to go down and try and do a refinance. This is you getting in now with this amazing low rate at a property that works perfectly for you. This is just the better way to buy real estate. So to kind of wrap this up, I want to go over a couple things with you guys. Like I said, it's not always the easiest process, the shortest process, but it is something that's going to get you so much more home. And there's actually a huge benefit we didn't even talk about yet. Think about this. The interest rates have been up over the last year, and most people that have 4% or lower interest rates bought them back in 2021. So they've already paid on that loan for 2 years, and you're going to be able to buy that property, and it's only going to have 28-year loan on it. So not only do you save yourself monthly or buy a bigger house, you actually have a shorter loan period. And it's only a couple of years that that person paid for. But when you're paying the first couple of years of interest, or first couple of years of payments, the interest is so much higher. So you're actually paying all this interest and less principal. So you're getting it a couple years in, you're going to pay more principal, you're going to save yourself on interest, you're going to have a much lower payment, or like we said, you're going to get just a house in a bigger house, a better house, nicer neighborhood, more bedrooms, more garage space, fully remodeled, a pool, whatever it is you're looking for, we're going to be able to help you. So if this is something of interest to you, would love to share with you more. Go ahead and schedule something on our calendars. Message us in the YouTube channel down below. Would love to help you out. I'm Gary Meek with the Living in Sacramento team. Hope you guys have a good one.